I'm Jared Dillian. This is the Jared Dillian Show. And this is a show about money and the stock market. And today, actually, real estate. And I look forward to talking with you about your money. Please call me to talk about your money at 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. Also, you can go to my website, which is jareddillianmoney.com. That's jareddillianmoney.com. Or you can follow me on Twitter at DailyDirtNap. And I am, by trade, a financial markets guy. for the last 20 years, I've been dealing with stocks, bonds, options, interest rates, currencies, commodities, pretty much anything in the financial markets. Actually, just a couple minutes ago, I had somebody on Twitter asked me, and the guy said, "You seem to be really well-rounded. Like, how do you know so much about?" And I said, early in my career, in the first 10 years of my career, if I had any free time, I was reading. I was reading all kinds of different books about the markets. I don't really do that anymore. I'm kind of done. But yeah, for the first 10 years, on the weekends, I guess I was lame, but I just stayed at home and I sat on the couch and I read books. And that's what I did. And, the interesting thing is that gave me a huge advantage over everyone else on Wall Street. For example, if you're they call you a cash equity trader, you just trade stocks. If you trade GE, your whole life revolves around GE. And you read the research reports and you know who's upgrading it and downgrading it, and you know who the big holders are and all that stuff. And that's your life, is trading GE stock. But there's a lot of other stuff going on in the world other than what's just happening with GE stock. I mean, there's a treasury bond market, there's the options market, there's all kinds of stuff. So, even though what I was doing at the time was something called index arbitrage, I took it upon myself to learn as much as humanly possible about every other asset class. And probably the asset class I learned the most about was the interest rate market, the bond market, which I studied a lot and learned a lot about. Now, having said that, I learned about stocks and bonds and credit and mortgages and all this stuff. The one thing that I never learned anything about was real estate. Because, if you're at a bank, there are people who do real estate, but it's a totally separate division, and I just never learned anything about real estate. If you said to me back then, if you started talking to me about things like cap rates, I have no idea what you were talking about. And I just don't know too much about real estate. And I'm not comfortable with real estate. I'm comfortable with a lot of stuff that other people aren't comfortable with. I trade and invest in some very exotic financial instruments, but I cannot get my head around buying a house and renting it out. For some reason, that seems hard. I don't know why, but that seems way harder than call options on Australian bank bill futures. That seems easier to me. I don't know. So literally, as much of a tough guy as I am in the markets, I am a chicken when it comes to real estate. And the reason why I'm scared of real estate is because of liquidity. And as I mentioned before, with my investment portfolio, I can be out of it in 10 minutes and turn the whole thing to cash and just be in cash and get rid of all the risk in 10 minutes. And if I had a portfolio of real estate, if I had condos and houses and buildings and stuff like that, it would take me years to get out of. And that's what scares me about real estate. But that's not all that scares me about real estate. The other thing that scares me about real estate is the leverage and the debt. It's just nobody really invests in real estate with cash. For example, if you were going to buy a house down the street that you were going to rent out and you were going to put on Airbnb or something like that, hopefully you would do the math, but you're unlikely to buy it with cash. You're probably going to put 20% down or 30% down and take a mortgage on the rest. Then you have to do this analysis. Okay, the mortgage is this much and the property taxes are this much and the insurance is this much. So this is the cash going out the door every month. And if I'm going to rent it on Airbnb, this is how much I'm going to get every month. Or, if I'm going to rent it on a long-term rental to a tenant, this is how much I'm going to get. So you have to do all that math. And it's also like, people view real estate as passive income. Oh, I'm just going to sit back and, be a landlord and collect rent checks. And it's not really passive income. It's a lot of work. Actually, when Airbnb first came out, I knew a guy in New York City, and this is kind of before New York City cracked down on a lot of the Airbnbs, but I knew a guy who had like 12 different apartments, and he was doing short-term rentals on Airbnbs, I think a minimum of 3 nights, but typically 3 to 7 days. And it was a lot of work because, he had to hire people to clean them and, manage all the communication and stuff like that. It's really like a full-time job. And like for him, it was a full-time job. And that's what he did for a living, was just doing Airbnbs on properties that he owned. I think he would tell you that it was not passive income. There was nothing passive about it. But in terms of the debt, we've talked about before, if you buy a $500,000 house and you put $100,000 down, if the value of the house goes down by 20%, if it goes from $500,000 to $400,000, then your equity is wiped out. You're just wiped out. So you took 100% loss. And that's what scares me because, I guess you can lose 100% in the stock market, but not usually all at once. And you have a chance to get out. So real estate, oh man. Some people do really well. Sam Zell is an example of probably the best real estate investor of all time. And the guy just has incredible instincts for how to time the cycle. Incredible instincts. He actually was basically liquidating his entire real estate portfolio just at the time that Lehman Brothers was loading up in 2007. It was uncanny. And, we were sitting there at the time, we're looking like Lehman Brothers is loading up on all this real estate. We're like, Sam Zell is selling. Like, that's not good. By the way, speaking of liquidity, the main reason that Lehman Brothers was allowed to go bankrupt and was not rescued was because of their real estate portfolio. So Lehman Brothers at the time of the bankruptcy had about $40 billion worth of real estate. And that was land, it was condos, it was apartment buildings, it was hotels, it was stuff all around the world. They couldn't buy it fast enough. They didn't even visit these properties. They just bought stuff sight unseen because it was just going up. It really was that dumb. And just to put that in perspective, the bank that had the next most real estate exposure was Morgan Stanley, who had $2 billion, and Lehman had $40 billion. So, when Hank Paulson and Dick Fuld and all these guys sat in a room and tried to figure out if they were going to bail out Lehman, they took a look at the real estate portfolio and they said, it is going to take years to liquidate this stuff. And by the way, Lehman has still not exited bankruptcy. Like the bankruptcy happened almost 11 years ago to the day. And 11 years later, they are still in bankruptcy, working its way through court because they are still selling assets 11 years later. That's insane. So that kind of gives you an idea of the illiquidity of real estate. Now, an example of a guy who loves real estate, and I really don't want to pick on him because I actually like him. He's a little nuts. It's Kiyosaki, who wrote Rich Dad, Poor Dad. And his formula for people getting rich was the passive income. To buy income-producing properties like real estate, but also, laundromats and basically anything that produces income. And I think he has had some difficulties over the years, but I don't know the details, so I want to go further than that. But, real estate is hard. And if you can get the cycles right, then, yeah, look, like, here in Myrtle Beach, I'm going to tell you some stories when we get back from the break. But if you got a hold of some, there were condos. There's an area here called Market Common, and during 2009, you could have bought a condo for $30,000. That exact same condo today is over $200,000. So if you have the cash, you have the liquidity, and prices are that low, you can make a fortune. I'm Jared Dillian. This is the Jared Dillian Show.